Warren Buffett has been investing for 60 years. 60 years of buying stocks, holding them, preaching patience, telling everyone that the stock market transfers money from the impatient to the patient, buy great businesses, and never sell. That's been his mantra. Except now he's selling, not trimming, selling aggressively. For 3 consecutive years, Berkshire Hathaway has been a net seller of equities, and the cash pile isn't being deployed. It's growing. $325.2 billion as of September 30th, 2025. The largest cash position in Berkshire's history, the largest any company has ever held. This is the man who said, "Never bet against America," who told investors to buy during 2008, who preached staying invested through every downturn for 6 decades. And he's selling stocks and hoarding cash. That should terrify you, because Buffett doesn't do this, ever. Until now. Let me show you exactly what he's doing, why it violates everything he's taught for 60 years, and what it means for your retirement account when the man who wrote the playbook on long-term investing decides the playbook no longer applies. Start with the numbers. Every quarter, Berkshire files a 13F with the SEC disclosing equity holdings. 3 years show the same pattern. Selling. Q3 2023, $318 billion. Q4 2023, $354 billion. Stock prices rose, share count declined. Q1 2024, $332 billion. Q2 2024, $280 billion. Q3 2024, $266 billion. 3 years of reduction. His largest holding, Apple. Berkshire owned 915 million shares at peak. Apple was over 50% of the portfolio. Buffett called it probably the best business I know in the world. But he's selling anyway. Q3 2024, Berkshire reduced Apple by 100 million shares, 11% in 1 quarter. Year over year, cut by 300 plus million shares, 33% reduction in the best business he knows. Apple is still largest position, but now 30% instead of 50%. And selling continues. Every filing shows further reductions. Buffett is systematically selling Apple while calling it wonderful. Why sell a wonderful business? Because even wonderful businesses aren't worth owning at the wrong price. At 33 times earnings, Apple is expensive. Buffett is getting out while it's dear. But it's not just Apple. Berkshire has been reducing across the board. Bank of America trimmed significantly, over $10 billion sold in Q3 and Q4 2024. Energy stocks sold, consumer discretionary sold, the portfolio is being liquidated. And Buffett isn't replacing what he sells. Normal years sell $20 billion, buy $25 billion. Net buying, but for 3 years, selling $40 billion, buying $10 billion, net selling. Portfolio shrinking, cash growing. $325.2 billion in cash. More than Finland's GDP, more than Costco's market cap. Enough to buy Nike, McDonald's, and Starbucks combined with $50 billion left over. Earning 5.4% in treasury bills, risk-free, $17.6 billion per year in interest. Why would he do this? Because Buffett only invests when he can find opportunities that meet his strict criteria. And right now, he can't find them. In his 2023 shareholder letter, he wrote clearly, "We have been unable to find entire companies or small portions thereof that offer us sufficient opportunity." Translation: everything is too expensive. Stocks are overvalued. Private equity is overpriced. Acquisitions don't make sense. There's nothing to buy at prices that justify the risk and meet his required return thresholds. So he's waiting, accumulating cash steadily and patiently, building the largest war chest in corporate history, preparing methodically for the moment when fear replaces greed and high-quality assets go on sale at reasonable prices. Because Buffett knows what happens during crashes. He's lived through enough of them to recognize the pattern. In 1974, he was buying stocks aggressively when everyone else was selling in panic. In 1987, he bought Coca-Cola after Black Monday. In 2008, he invested in Goldman Sachs and General Electric when the financial system was collapsing. In 2020, he bought stocks during the COVID crash when panic created opportunities. Every time panic hits, Buffett deploys cash. He buys great businesses at distressed prices. And when the market recovers, those purchases generate extraordinary returns over the following years. That's the playbook. That's the playbook. Sell high, hold cash, wait for the crash, buy low. And right now Buffett is in the selling high and holding cash phase, which means he expects the crash phase to arrive soon. But here's what's terrifying. Buffett has never held this much cash for this long. In previous cycles, his cash position peaked at $150 billion before he found opportunities. This time, he's at $325 billion and still accumulating. He's not even slowing down the selling. Every quarter, more stocks liquidated, more cash raised. This isn't a tactical pause. This is strategic positioning for something big. Let me show you the historical pattern because Buffett's behavior before major market downturns is remarkably consistent. Before the dot-com crash in 2000, Berkshire was holding high levels of cash. Buffett refused to buy technology stocks because valuations were insane. Everyone called him out of touch. Then the market crashed 50% and Buffett deployed his cash into undervalued assets. Before the 2008 financial crisis, Berkshire's cash position was elevated. Buffett could see that housing prices were unsustainable, that banks were over-leveraged, that credit was too loose. He didn't predict the exact timing, but he positioned defensively. When Lehman collapsed, Buffett had cash to deploy. He bought Goldman Sachs preferred shares at terms that generated billions in profit. Before the 2020 COVID crash, Berkshire had been accumulating cash. The market was expensive. Valuations were stretched. Then COVID hit, markets crashed, and Buffett didn't deploy as aggressively as expected. Why? Because he thought valuations didn't fall far enough. The Fed's intervention prevented a true bear market. Stocks recovered too quickly. Buffett never got the buying opportunity he wanted. So he kept holding cash, and he kept selling. Now we're in 2026. Buffett has been raising cash for 3 years. The S&P 500 is trading at 22 times forward earnings. That's expensive by historical standards. Only sustained above 22 during 2 periods. The dot-com bubble, 1998-2000, and the COVID stimulus bubble, 2020-2021. Both times ended badly. Dot-com crash was 49% decline. COVID correction was 25% decline. Right now, we're back above 22 times earnings, and Buffett is selling. The message is clear. Buffett sees the same setup: expensive valuations, excessive optimism, concentration risk in a handful of mega-cap tech stocks, deteriorating economic fundamentals hidden by strong headline numbers, credit stress building beneath the surface, and he's positioning for the inevitable repricing. But Buffett can't just say, "I think the market will crash," in an interview. That would trigger the crash. So instead, he acts. He sells, he accumulates cash, and he waits for investors to figure it out on their own. His actions are the warning. $325 billion cash is the signal. If you understand what it means, you have time to position defensively. If you ignore it, you'll be caught in the downdraft when it starts. Now let me show you what Buffett is waiting for, because he's not holding cash forever. He's holding it for a specific opportunity. And that opportunity is a market decline of 30 to 40% that makes stocks cheap again. Buffett's favorite valuation metric is the Buffett indicator, total stock market capitalization divided by GDP. When the ratio exceeds 150%, the market is overvalued. When it falls below 80%, the market is undervalued. Right now, the Buffett indicator is at 186%. That's higher than the dot-com peak of 148%. It's higher than the 2021 peak of 210%, but not by much. Historically, when this indicator exceeds 150%, forward returns are poor. When it falls below 100%, forward returns are excellent. Buffett is waiting for the indicator to fall below 100%. That would require either stock prices to decline by 46% or GDP to grow substantially while stock prices stay flat. GDP isn't growing substantially, so Buffett is waiting for stock prices to fall. And when they do, when the S&P 500 drops from 6,000 to 3,600, when panic selling creates forced liquidations, when fear dominates and nobody wants to buy, Buffett will deploy that $325 billion. He'll buy stocks at 10, 12 times earnings instead of 22 times. He'll acquire entire companies at distressed valuations. He'll make investments that generate 15-20% annual returns for the next decade. And when the market eventually recovers in 2027 or 2028, Berkshire's value will have increased by $150-200 billion from those purchases alone. That's the playbook. That's what $325 billion in cash is waiting for. But here's the critical question. If Buffett sees a crash coming, why isn't he saying so publicly? Why does he keep writing in shareholder letters that America's best days lie ahead while simultaneously selling stocks? Because Buffett is an optimist about America's long-term future. He believes in capitalism, innovation, human ingenuity. He thinks the economy will be larger in 2050 than it is today. But long-term optimism doesn't mean you overpay for assets today. You can believe in America's future and still think the stock market is overvalued. Those aren't contradictory positions. Buffett's message has always been, own stocks for the long term, but don't overpay. Buy when others are fearful. Sell when others are greedy. And right now, others are greedy. The S&P 500 just hit all-time highs. Retail investors are piling into index funds. Options volume is at record levels. Speculative behavior is rampant. And Buffett, the ultimate contrarian, is doing the opposite of the crowd. He's selling. This is what makes his current behavior so significant. Buffett isn't a market timer. He doesn't try to predict short-term movements, but he does adjust his activity level based on opportunity. When stocks are cheap, he's aggressive. When stocks are expensive, he's defensive. And right now, he's more defensive than he's been in 60 years. That's not market timing. That's valuation discipline. And the valuation discipline says, don't buy at 22 times earnings when you can wait for 10 times earnings. Now let me show you the consequences of ignoring Buffett's signal, because most investors will ignore it. They'll stay fully invested. They'll trust the financial media saying this time is different. They'll believe their advisor telling them to stay the course. And when the market declines 30, 40%, they'll lose decades of gains in months. Here's what a 40% drawdown means practically. If you have $1 million invested in an S&P 500 index fund today, a 40% decline leaves you with $600,000. To get back to $1 million, you need a 67% gain. That takes years. Meanwhile, Buffett, who sold at the top and held cash, will buy back into the market at the bottom with his $325 billion. His $325 billion becomes $500 to $600 billion when the market recovers. Your $1 million struggles to get back to $1 million. This is the wealth transfer mechanism. From the impatient to the patient, from the emotional to the disciplined, from those who ignore valuation to those who respect it. Buffett has been on the right side of this transfer for 60 years, and he's positioning to be on the right side again. So what should you do? Not sell everything. That's not what Buffett is doing either. Berkshire still holds $266 billion in stocks, but Berkshire has also raised $325 billion in cash. That's a 55% cash position. 55%. The average investor is maybe 5% cash. That's a problem. You should be increasing your cash allocation. Not to zero stocks, but to a level where a major decline doesn't destroy you. If you're currently 95% stocks and 5% cash, consider shifting to 70% stocks and 30% cash. That 30% gives you optionality. When stocks fall, you have buying power. You can do what Buffett does, buy when others panic. You should be reducing exposure to the most expensive parts of the market. Technology stocks trading at 30, 40 times earnings. Speculative growth stocks with no profits. Anything that's been bid up by momentum and hype. These are the stocks Buffett is avoiding. These are the stocks that fall hardest when sentiment shifts. You should be owning defensive assets, utilities, consumer staples, healthcare, businesses that generate steady cash flow regardless of economic conditions. Buffett isn't just holding cash. He still owns BNSF Railway, Berkshire Hathaway Energy, insurance companies. Boring businesses that work in all environments. You should own those too. And most importantly, you should be patient. Buffett's $325 billion isn't being deployed today or tomorrow. It's being held for the opportunity. And when that opportunity arrives, when valuations are compelling and fear is high, that's when you act, not before. Warren Buffett just did something he's never done in 60 years. He's holding more cash than stocks. He's selling his highest conviction positions. He's building the largest war chest in history while the market hits all-time highs. This is the signal. This is the warning. The question is whether you'll listen to what the greatest investor in history is telling you, not with words, but with actions. Because actions, especially Buffett's actions, speak louder than any interview or shareholder letter ever could. $325 billion in cash. 3 years of net selling. The most defensive positioning in Berkshire's history. That's not a coincidence. That's preparation. And if Warren Buffett is preparing for something, you should be too.